morning and welcome to Pew Charitable Trust webinar announcing the findings from Who's Winning the Clean Energy Race 2013. This webinar is being recorded and will later be posted online at pewtrust.org/cleanenergy, perhaps later today. We will take questions from the audience at the end of the presentation. You can pose your question at any time via the chat box and simply write in your question to the host. And with that, I will turn it over to Phyllis Cutno.
Well, thank you, Tracy. My name is Phyllis Cutno. I direct the Clean Energy Program here at the Pew Charitable Trust, and I want to thank all of you for joining us today for the release of our 5th edition of Who's Winning the Clean Energy Race. This report, as the others have, reviews 2013 data on clean energy investment and deployment trends among G20 nations and around the world. And as always, this report is a collaboration between the Pew Charitable Trust and Bloomberg New Energy Finance, or BNEF. I am delighted to be joined today by Ethan Zindler. Ethan is both the head of the Americas and head of policy at BNEF, and together we'll present the data, explore some trends, and then, of course, as Tracy mentioned, we'll try and save plenty of time for Q&A, and hopefully you'll have lots of questions. So let me start by highlighting several key takeaways evident from the data. In 2013, we saw the continuation and, frankly, the intensification of geographic and technological shifts. The migration of investment from west to east accelerated as the European market fell sharply, and Asia attracted almost double the investment of any other region. We also saw developed markets, as developed markets contracted, new markets opened in Latin America and Africa and Asia, and while many are small, together they point to the emergence of a truly global industry. And then on the technology front, solar is displacing wind as the leading clean energy technology. Now, even as investment has fallen back, clean energy deployment is strong, and that's in large part due to technology price reductions that are a result of efficiency gains in the manufacturing process and across the value chain. You know, solar costs in the United States, for instance, declined 60% since 2011. So as a result, clean energy is becoming more and more competitive with incumbent energy technologies and therefore even more attractive in the marketplace. And in addition to technology price reductions, there are promising new financial innovations emerging, from third-party financing operations to clean energy real estate investment trusts to Warren Buffett's solar bond through Mid-American Energy. All are providing new private and lower-cost pools of capital. And then finally, over the last 5 years of producing this report, one takeaway has been constant, which is that investment flows to countries with policy certainty, and policy matters. So with that as an introduction, let's jump to some of the key data. So let's look at the investment overall. It was down for the second straight year, falling 11% to $254 billion. You can see the yellow line at the top of that blue bar, which, as I mentioned earlier, you can see that's investment in non-G20 countries, and it continues to grow each year. In fact, investment fell 16% in the G20, but was up by that amount in non-G20 countries. So clearly, new markets are opening up in smaller economies, and where clean energy is increasingly attractive for meeting both electrification needs and economic goals. Now, if we could have the next chart. Great. Now, this chart graphically demonstrates the west-east movement of capital that I mentioned earlier. If you take a look at that dark blue bar, this is perhaps one of the most striking findings, was that this is the European region, and it was down 42% in terms of investment. 42% to Europe to $55 billion. That is half of, or less than half of the 2011 level. And some of the long-term European leaders fell even more sharply. So Germany's investment was off 55%, Italy's off 75%, and Spain's down by even more. And then you'll see the contrast. Investment in the Asia-Oceania region continued to march upward. There you'll see the light blue bar. and this is increasing 10% to 102 billion, in 2013, and that's largely due to strong numbers coming out of China, out of Japan, and out of India. And then the green bar, our own backyard, the Americas region, was relatively steady, with investment falling 8% to 52 billion on the basis of a slight U.S. backsliding and a sharp drop in Brazil. So now let's turn to technology. Can I have the next slide, please? Great. So there's increasing evidence, as you'll see here, that the solar sector is emerging as the industry's leader. 2013 was the fourth year in a row in which solar led all technologies in terms of investment, accounting for 97 billion. That's more than half of the G20 total. But wind investment was steady at 73 billion. See, that's the blue bar. So overall, there are now 735 gigawatts of renewable installed capacity around the world. 87 gigawatts were installed just last year. And this chart breaks down the technologies, and it really shows you, frankly, how much solar has to catch up with wind where installations are concerned. Still, solar made some impressive gains in 2013 with a record 40 gigawatts installed, bringing that total to 144 gigawatts. And to put that in perspective, remember that only 4 gigawatts of solar were installed over the entirety of a 10-year period from 2001 to 2010. So almost one-third of all solar on the planet was installed last year. It's interesting to note, again, that even though investment was down 20%, the deployment of solar was up 29%. And that, again, demonstrates the earlier point about how falling prices are really driving these technologies deployment around the world. Wind installations were off 44% in 2013, with 27 gigawatts installed, and frankly, much of that decline can be attributed to the sharp drop in U.S. wind capacity additions, and we'll talk about that in a moment when we look at American trends. So each year we examine 5 types of financing, and you'll see from this chart that the 2 largest categories, asset finance and small distributed capacity, those are on the right, were down by 14% and 29% respectively. Venture capital investment continued to slide, a consistent trend we've been seeing in recent years. VC investments at the front end of technology development process were down 32% to just $4 billion. But the news isn't all bad. The public market financing increased 176% to $10 billion, and in this category, companies turn to the stock markets to raise money to scale up their operations. And consistent with this, the value of clean energy stocks on a leading index rose 54% in 2013, outpacing even the S&P 500. So these increased stock prices seem to suggest, and I know Ethan will talk a bit more about this, that the clean energy industry has weathered the end of stimulus programs and kind of intense competitive pressures, and those companies that have survived have begun to look like promising opportunities for investors. So, of course, now we need to turn to the race. Who is winning the clean energy race? Well, here several countries bear special mention. We should start with China, which has emerged really in recent years as the world's clean energy leader. And our 2013 data only reinforces that impression. First, China attracted a world-leading $54 billion worth of investment. It was first in wind and second in solar investment, and really it lapped the field in terms of deployment. In 2013, the country installed more than 14 gigawatts of new wind and remarkably 12 gigawatts of solar. So in 1 year, China deployed the most solar ever, quadrupling its solar installations. No clean energy market in the world is operating at that scale. So the second, of course, is the United States, and Japan jumped to third, displacing Germany, which has been in third place for quite some time, I think, in all the 5 years that we've been doing this report. Now, last year, only 3 companies experienced clean energy investment growth, and so let's take a look at those. As you can see, Japan clearly tops the list. They grew 80% to $28 billion. It also led the world in attracting solar investment, which was really a result of their drive to diversify their electric capacity, generating capacity in the wake of Fukushima. Japan now has the 4th highest amount of deployed solar behind Germany, China, and Italy. Second on the list, of course, is Canada, which grew by 45% to $6.5 billion, largely as a result of investors seeking to take advantage of some key clean energy incentives just prior to changes in the Green Energy Act that was enacted in Ontario. With the drawdown in those incentives, we're going to be watching Canada's levels closely over the next year, see how they react. Third in growth is the UK. Investment increased there by 13% as several large wind projects were completed, and overall the UK added 2 gigawatts of wind just last year. And so finally, what about the United States, which is sixth here on our growth list? Well, overall U.S. investment was off 9% to $36.7 billion. We again led the world in attracting investment in the biofuels and energy efficiency and low carbon categories. That's a growing category of investment. Globally, we were second for wind and third in solar investments. We continue to dominate the venture capital category, although it is shrinking, as I mentioned earlier. And with more than $17 billion invested in the solar sector last year, the U.S. installed 4.4 gigawatts of solar, 30% more than in 2012, and an all-time record for the U.S. So that's great news. Third-party financing mechanisms, again, something that Ethan is going to speak to in a few minutes, have really been driving that solar deployment. In the wind sector, we saw what appeared to be some counterintuitive results. Investment was relatively steady at $14 billion, but installations fell dramatically, more than 90%, from 13 gigawatts to less than 1 gigawatt. So why? Well, again, uncertainty and policy changes were associated with the renewal of the production tax credit, or the PTC, in early 2013 severely impacted the sector. That revised PTC encouraged investment, but not project completion in calendar year 2013. So it's really expected that deployment will rebound this year in 2014, but we've begun that roller coaster ride once again, as just today the Senate Finance Committee is marking up tax incentives legislation, and the fate of the PTC is being debated and will be debated later this year. So once again, whether it's South Africa, China, Japan, Canada, Germany, or the United States, what we find is policy matters. So before I turn it over to Ethan, let me just finish with a few thoughts about the future. Like many other observers, I'm upbeat about the future of the industry. And after all, in less than a decade, it's established itself as a $250 billion annual fixture of the global economy in spite of a set of really withering challenges, massive oversupply and resulting consolidation, a recession, and austerity policies that have really given a lot of investors pause, and frankly, the lack of a cohesive or even intelligible global response to the climate crisis. And still, prices continuing to come down, no other energy technology has that kind of consistent track record. And given the progress and the ongoing work to reduce manufacturing and balance the system and soft costs, there's just every reason to expect that clean energy will be ever more competitive in the marketplace in the future. And it's, again, very encouraging that new financial models are helping these broader, cheaper pools of capital emerging. And these new markets in places like Chile and Uruguay and Kenya are real opportunities. So all of these trends bode well and point to a future in which clean energy delivers all of the economic, the environmental, and security benefits to the U.S. and to other countries around the world. And we look forward to continuing to track its progress, particularly as it relates to both investment, deployment, and policy. And so with that, I'm going to turn it over to Ethan Zindler. Ethan, as always, it was a pleasure to partner with BNEF on this report, and we really thank you for being here to share your insights and analysis and answer questions.
Great. Well, thanks, Phyllis. And thanks, of course, to all of Pew, in particular to Phyllis and to Tracy, Jessica, David Harwood. This is the fifth year we've partnered on this report where we essentially provide the underlying data, and they help with doing the analysis and the writing and making it look great and really saying such smart things about what it all means. And so thanks again. It's been a lot of fun. I think Phyllis did a terrific job of covering a lot of ground and sort of really stating the main points. I'm just going to try and amplify just a few things, and then we'll quickly finish up and get to some questions from everybody. So if you could jump to the next slide, which is the one with the regional investment. In terms of investment by region, just as Phyllis was saying earlier, I thought it'd be useful just to show a little bit longer-term picture of the kind of trends that we've seen. And to her point, really, you can see if you roll the clock back several years, there was a time where Europe really was the driving force in terms of where most of the, or at least a majority of the capital that was being deployed was taking place. And really not so long ago, as recently as 2010 or 11. But you can see from this chart just how much the decline has taken place. And by the way, these figures, just a small note, these are slightly different than the ones in the report, and if anyone would like sort of a quick explanation for why that is, happy to give that, but I really show these mainly for illustrative purposes. These include a few other things that the report doesn't, but the general trends here are really what's key. And then, of course, most importantly, in terms of those trends, you can see the Asian-Oceania region overall has really continued to surge 2011, 12, and 13. And as you can see, even though actually the Chinese market wasn't growing at any massive rate in terms of dollars last year, the Asia region continued to pick up largely because of Japan and the interesting things that have been taking place over there. In terms of Central and South America, just for a moment, as was alluded to, one of the interesting things we've seen is that investment in Brazil has, which is by far the largest market, largest national market in Latin America, has really declined, but a good deal of the slack has been picked up by a variety of other countries, including Mexico, Uruguay, and Chile. And in fact, we expect to see more, particularly out of Mexico, this year. So there's definitely, even within some of these developing world regions, you're seeing more of a diversification taking place across the kinds of countries that are attracting investment. And finally, on the Middle East and Africa, of that the figures you're seeing there, the large majority of that has been, well, not majority, but I would say a large chunk of that has been South Africa. It was really the primary sub-Saharan African nation attracting actual large amounts of capital, but certainly we've seen activity in North Africa as well. And now if we would to the next slide, slide 15. And again, as Phyllis was mentioning, one area of sort of a real bright spot for last year was activity that we saw over the public markets. And just to be clear what that means money that gets raised over stock exchanges or by the flotation of bonds, basically the kinds of things that investors can buy, from their desk. Not sophisticated type project investments, but things like stocks and bonds that you or me or anybody can simply buy a share of. Last year was a very good year for that, and if you this again is just to sort of give a historical context. If you look back to 2007, you can see what a spectacular year the industry had then. There were a lot of IPOs of biofuels companies, solar companies, and things like that, which really raised a lot of capital over the stock exchanges. But the last 2 years, 2011 and in particular 2012, were very difficult for the industry in terms of raising money. This was in part because the values of the stocks that were trading were quite down. And that really has rebounded sharply, as Phyllis alluded to. One index, which is the NEX that our firm looks after, has more than doubled in the last couple of years. It was up, as Phyllis mentioned, 50%, over 50% in 2013. It was a great year on Wall Street generally, with a lot of indices rising, but still clean energy stocks actually outperformed the NASDAQ, the New York Stock Exchange, the S&P 500. Really had a terrific year overall. One other note just on public market activity, without getting too technical here, I just want to make one other point, which is that one trend that we continue to see accelerate in 2013 were companies raising more money from the issuance of bonds, as well as so-called yield companies, that is, companies that get specifically set up so that the investors can earn money off the cash flows that a certain set of projects operating generate. Why this is important is because despite that roughly $250 billion that was invested last year and the amounts in the over $1.5 trillion that we've seen cumulatively since our firm was founded 10 years ago, the vast majority of that hasn't been raised in this way. And this is how the conventional power sector typically does raise money, via bond offerings, master limited partnerships, and other types of vehicles that tap into the power of the stock markets and the bond markets. So more of this type of activity is important for the industry to continue to grow, and we are seeing more of it take place. The next slide, please. And then I'm just going to finish with a couple quick comments, as Phyllis alluded to, about the U.S. And in particular talking about the wind market in the United States, which is really an interesting one. So the slide that you see in front of you here looks at the rate of capacity that's been built in the U.S. year on year dating back to 2008, and this is in gigawatts of new capacity additions. And the historical figures obviously are in dark purple. And then as you look towards the right, we forecast out what we think is going to be installed year on year. The way the blocks are split is simply based on how we're tracking it. Some projects have been got financing, some have simply been announced, some we're anticipating being announced. But effectively, if you total up those chunks, you can see what our forecast looks like for 2014 and beyond. But sticking just on the last 2 years for just a moment, as Phyllis alluded to, 2012 really was a record year for U.S. wind installation, with 13.8 gigawatts of new capacity added on U.S. soil. But 2013, as you can see, activity fell by well over 90% to less than 1 gigawatt of new capacity being installed. And effectively, what happened is roughly 2 years of U.S. wind build got crammed into one, which was 2012, as everybody tried to beat the clock on the expiration of the U.S. production tax credit. It did, I guess, technically actually expire for a moment, and then Congress extended it for a year in 2013. And as Phyllis mentions, now there's quite a discussion about what happens next. And just to underline one thing, in terms of the forecast you see here, this is our firm's assumption of how much wind will get built year on year in the United States if there is no extension of the U.S. Production tax credit. You may ask, well, why are we going to see a rebound in 2014 and 2015 in terms of new capacity if there is no tax credit? The reason for that is because those are projects that effectively are going to benefit from the tax credit because they were officially under construction by the end of last year. So this is the pipeline of projects that still will receive the benefit. It's not until 2016, 17, 18 that those new projects getting built essentially will not get the PTC benefit. And the fact that those are going to get built is a reflection of the fact that wind is actually increasingly economically competitive in the U.S. But still, the decline that you see, 2016 and beyond, is a representative of how the industry will probably be impacted if the PTC is not extended. So if you would to the next and last slide. So this is just simply our revised forecast if you assume the PTC does get extended permanently. That is not just a one-year extension, but that it just simply stays on the books. And you can see, obviously, that the decline that we're anticipating into 2016 and beyond are no longer there, and we probably are going to reach a market of around 7,000 megawatts or 7 gigawatts per year starting in 2017 and beyond. But again, this is obviously forecasting based on our understanding of what projects are under development and what the opportunities are in certain markets in terms of cost competitiveness. But I think it underlines the basic point is that the PTC still does very much obviously matter to the U.S. wind industry, at least particularly in the shortest run, but beyond that, longer term as well. I guess I'd make one last point before I wrap up, which isn't on the slide here, which is just that there's no question that some of the scale backs and policy supports that we've seen in places like Germany and Italy and elsewhere very much had an impact on the amount of new capital that was invested in clean energy this year. But the somewhat ironic thing is that despite the impact of those policy changes, the industry itself is becoming more economically competitive than ever before. And so you see places where wind and solar truly, and geothermal in particular, really can compete with little to no subsidies. But the problem is that that phenomenon does not take place coincidentally in all places at the same time. So we're starting to see places, if you're in a particularly sunny part of the world with particularly high electricity prices, then putting a solar system on your roof clearly can make more sense than, say, burning kerosene to keep the lights on in your house. Or if you live in a windy part of the world, a wind power project clearly can make more economic sense than coal or even natural gas in some parts of the world. But this doesn't happen everywhere, and it won't happen everywhere at the same time. So effectively, we're in a bit of a transition period for the industry as some subsidies are scaled back and as the industry increases its economic competitiveness. But our long-term view is that the industry will continue to be more competitive going forward, and subsidies will become less and less important. But in the short term, they are still vital in a number of parts of the world. So with that, we just want to say thanks again to Pew, and happy to take any questions that there are.
Okay. Thanks, Ethan. Okay, so Tracy, do we have questions?
We have several clarification questions focused on Asia. So the first one goes to Ethan. Can you break out or better describe the role of government investment versus private investment in Asia?
Sure, though it's always somewhat of a loaded question, and particularly in China. In China, you have a lot of things that are companies, but they are effectively state-owned entities, or they're partially state-owned entities. And so figuring out where government money begins and where private capital, begins can certainly be challenging. For the sake of how we do it, if something is essentially a partially state-owned entity, we count that essentially as private capital. It's very tricky for us to do otherwise. We also count in terms of dollar investment, money that comes from the China Development Bank. We count that as a asset finance for a project. What we don't count in these asset financings, in China in particular, but elsewhere actually for that matter, is the value of something like a feed-in tariff. So in other words, if you're able to sell your power at essentially a market premium rate because of a feed-in tariff, that's extra revenue that you're receiving. We don't count that as a government, we don't count that as a asset expenditure in these figures. That is clearly a subsidy, and it's not in the overall totals. So I hope that helps a little bit, but it's a tricky question that we've dealt with before, because certainly you run into gray areas when it comes to development banks, loan guarantees, and other things like that.
Phyllis, there's a widening gap between the U.S. and China in the global race. Do you foresee the U.S. being able to close that gap, and what's your insight on that race?
Well, I think, we worked with Bloomberg Energy Finance on another report which looked at U.S. and or trade between the U.S. and China and when it comes to clean energy. And one of the most interesting points, I think, of that report was that we have certain strengths and China has certain strengths. And their strengths are in low-cost assembly. Our strengths are in innovation and advanced manufacturing. And I think when you look at the race between the U.S. and China, the United States should really see China as an export opportunity, and we should try to, when it comes to the clean energy economy, I think, really protect and invest in those things that we do well, so innovation, advanced manufacturing, at the same time that we're trying, have policy in place that makes sure that our clean energy economy here in the United States is the strongest it can be. So, in terms of deploying the same number of gigawatts into the future, or just, an amount of investment, I think China's leadership is probably here to stay, but it's an important sector of the economy for us. And our opportunity here at home, but also to export around the world, is really critical. But I don't know, Ethan, you may have a different perspective that you want to add.
No, I mean, I wouldn't really disagree with any of that. I would just simply say that the challenge always for the U.S. when it comes to manufacturing is the trend towards commoditization that can take place around the world, and that the moment an industry sort of reaches scale and becomes commoditized, that is that the competition takes place entirely based on cost, not necessarily as much as on quality, it can be very challenging for the U.S. So the key for U.S. manufacturing competitiveness, I think, is always to try and stay one step ahead of the curve by manufacturing the most advanced types of equipment. We apply that sort of to, say, for instance, the solar industry. Some of the best opportunities, I think, typically in the past for the U.S. has been around the manufacturing of capital equipment. That is, the equipment that makes solar panels, not making the solar panels themselves, but the very sophisticated devices that are needed to actually make that equipment. And so we've seen some successful companies in that area in the past, at least, and that's the kind of place that I think that countries like the U.S. and other Western countries that are very focused on having good-paying, manufacturing jobs. Typically, that's where they can have a competitive advantage potentially.
Well, I think that points up another thing when it comes to policy, which is the investments that the United States makes in supporting innovation and trying to drive down costs are really critical, and that we should try and maintain or increase those budgets to the amount, as much as we can, because it is an investment in this sector and in the future and in U.S. leadership and innovation, and it's just really critical. So that's another way that policy matters.
And along those lines, feed-in tariffs have been a driver in deploying solar. So, Ethan, can you share your perspective on feed-in tariffs and how that impacts the cost to produce electricity? And now that some of these subsidies are declining, is that attributable to the investment decline as well?
Sure. So, to some degree, feed-in tariffs are the sort of most direct way in which a government can inject subsidy support for clean energy. Because essentially, what they are, generally speaking, are mandates or rules that simply say if you're producing, a clean kilowatt hour of wind or solar generated electricity, then you can sell that into the grid at a fixed price. That essentially is above the market, the typical market rate, and that's they're very effective in that manner, in the sense that the project developer or owner of the system, has a certain high degree of certainty that if their project performs as they expect it to over the course of a 15 or 20-year lifetime, they'll generate cash flows at a certain very reasonable, or in some cases quite generous rate. And these have been spectacularly successful in spurring deployment in a number of countries around the world. The flip side, in some cases, has been that they've been, you might even say, too successful, in that they have spurred more deployment than policymakers were anticipating, and thus the cost of paying for that electricity, that premium for that electricity, ends up being a bit higher than the regulators may have expected. And so, that has certainly been the case. There's the concern in Spain, but also places like Italy as well. And that's prompting, policymakers to try and think of new, other kinds of creative solutions to be supportive to the industry that isn't maybe quite so direct, or just to go back to feed-in tariffs, to find ways to try and price the feed-in tariff at a little bit more realistic rates, so that you're providing the right amount of support to grow the industry, but perhaps not so much support that you can't manage the potential liability that comes along with those higher electricity costs that the government or the utility has to bear.
Okay, thank you. Then one of the questions is asking about biofuels, and whether or not we could expand a little bit on the trends and perhaps an address the declines in Brazil. Ethan, perhaps you can go first.
Sure. So, this has been a bit of a pattern now for the last several years. I guess maybe I'll quickly just start, with the U.S., which is that the U.S. saw this fairly amazing boom in new biofuel production capacity that topped out several years ago, and effectively the U.S. Built more ethanol production capacity than frankly it probably could have used, given the policies that were in place mandating biofuels consumption. And to some degree, it's been a game of trying to catch up with that extra capacity for several years now. The situation has gotten a bit more complicated as well by the fact that there is a direct conflict in the U.S. Between one law that simply has mandated that the U.S. consume more and more amounts of biofuels each year, which is known as the Renewable Fuel Standard, and essentially another set of rules, sort of informally known as the blend wall, that effectively makes it very difficult to legally consume more than 10% conventional ethanol in the U.S. And these two have run sort of headlong into each other recently, and the EPA effectively so far has come down more on the side of the blend wall, which has made it very difficult for the industry to continue to grow in terms of conventional ethanol supply. Now, the Brazil situation, there's a lot of things going on in Brazil to make things complicated. The first is that the economy in Brazil has slowed fairly substantially, and that has certainly made things challenging. The second is that the policymakers down there have had trouble at times finding the right balance between trying to essentially support biofuel use versus gasoline, and it's all the more complex by the fact that Petrobras, which is a massive state-controlled oil company, has an interest in trying to be profitable, that the state has an interest in, but has essentially been in the uncomfortable position of having to import gasoline into the country and effectively sell it at a loss for a variety of reasons that effectively made it difficult for ethanol. And the main one, the reason why Petrobras has to sell it for a loss, is that Brazil also effectively, in fact literally, caps the price at which gasoline can be sold. So if you cap the price at which gasoline can be sold and keep it artificially low, that makes it hard for ethanol to compete in the marketplace down there. And that, vastly oversimplifying things, has definitely been playing quite a role in the Brazil situation as well. And then finally, that those who own the plants down there, who are often family-owned plants that run sugarcane production along with ethanol, these families have not been making the kinds of reinvestments into their plants over the last several years that are necessary to increase the yield and production and continue to grow the industry. And so that's been sort of self-fulfilling as well. So it's a long answer, but I hopefully a useful one.
Thank you. Then there's a question about Canada. Phyllis, you mentioned that policy matters, both here in the U.S. and throughout the U.S. And throughout the world. So was the one-year increase in Canada because of policy changes in Ontario? Is that going to, do you expect a decline next year, or how does the policy in Ontario kind of impact the future for Canada?
Yeah, well, I think, I mentioned that we're going to be very interested in seeing what the results show next year, because it is only one province. But, you look at what happened in the United States with the PTC, for instance, and so I hate to predict the future. I'd probably best leave that to Ethan, but I think Canada is definitely, it's one of those that are on our watch list for next year, given kind of that pullback in the policy. So we'll see.
I'll just add one thing. We was actually lucky enough to be up in Canada for most of a few weeks ago, and indeed, what's going on in Ontario, there is that potential in that they have, somewhat similar to Europe, they have been reducing the support of their feed-in tariff, and in somewhat similar story to the U.S. In anticipation of that reduction of the feed-in tariff, there was a bit of a rush to invest and build projects over the last couple of years there as well. So there is the potential there, but as Phyllis mentioned, it's certainly not the only province in Canada, but it's pretty much been, well, has been among the most supportive so far. It certainly struck me from my trip to Canada how much energy policy really is set at the provincial level there, and much less so than at the national and federal level. And thus, you have a number of provinces that really aren't doing that much in this area. In the central and western part of the country. Of course, British Columbia is doing some things, but really most of the activity has been around Ontario and Quebec.
Ethan, I'm going to become a participant and ask you a question. What do you think will be the result of these attempts to roll back state renewable, RPSs or RESs that we've been seeing?
Well, I won't. Yeah, I won't venture a guess as to whether or not the political efforts will succeed. I just don't. I don't know. I will say that the renewable portfolio standards have really been very much critical to the industry so far. But I would. One last thing, or a few other things, but I would say is the key thing to do is as you try and think about market impact in these certain states, is to really scrutinize what's happening in those states. So, there are actually a number of states now where the renewable portfolio standard goals are being met or exceeded even. And thus, if you were to change the renewable portfolio standards legally, it wouldn't actually make that big a difference, at least in the short run. It would in the long run. And then there's other markets where, where they're having trouble hitting the targets, and obviously if you remove the targets, it would make a short-run impact. But you'd be surprised at how many markets there are now which at the very moment essentially are reaching their goals, in part maybe because some of the goals, if anything, weren't that ambitious to begin with, and could be more ambitious going forward. So, I can, again, so the first thing I would say in terms of trying to understand market impact is take a look at whether these fights are taking place in states where the goals are being achieved or not being achieved, and that'll give you an understanding as to how important the impact would be in the short run. But regardless, over the long run, I think there's no question that removing these would certainly put a dent in potential demand. The RPS have been probably next to or on par with the stimulus program, one of the most important policy drivers in the U.S. in terms of clean energy development.
Well, we've certainly seen with China where they have essentially made their, gone back and revisited their clean energy goals and made them even more ambitious. It's only served to help drive investment there. So, Tracy, do we have?
Yep, two more questions. The first is about venture capital. There was a decrease. Ethan, do you have any sense of what the potential outlook for venture capital will be in 2014?
Yeah, that's a tough one. We haven't forecasted it ourselves, and I would say that it's hard to know. I will say this, that I do think that, weirdly enough, or rightly or wrongly, that when you see companies successfully IPO on the public stock exchanges, that can be a positive sign for venture capital, sort of ironically enough. In other words, what is it that a venture capital investor wants more than anything? And that is the belief that the company that they invest in is going to be the next Google or Facebook or whatever, and debut on the stock exchange and allow them to sell their shares and earn a very generous return. There have been very few of those kinds of positive anecdotes about clean energy and the stock exchanges over the last several years. And so, but, last year, like as we showed in our figures, public market activity did start to pick up in terms of some of the stock offerings that were out there. And there are other IPOs. The Solar City, obviously, last year was a big one, but there are other ones coming this year as well. I know that OPower has filed for one as well. And so those kinds of things can make venture investors feel a bit more bullish about the industry. Now, venture investors will always tell you, oh, well, we're thinking 5 years down the road, and whatever's happening at this very moment isn't relevant to us. That's true to some degree, but I have to say that when they themselves need to go and raise money from limited partner investors, and they themselves need to show those limited partner investors that their investments are going to pay off, it's often a lot easier for them to do that when they can point to a big hot IPO that's just taken place in the field that they want to be investing those funds into. So again, there is the possibility that an upturn in the public exchange is going to help with venture investing a bit this year, but we'll have to see. And then one last just quick point, though, on investment in new technologies that I just always like to sort of caveat our VC numbers with, which is that there's a lot of activity that takes place in investing in new technologies that takes place in corporate labs, and that kind of stuff is not nearly so easy to keep track of. And so while certainly the decline in venture capital investment is disheartening, I think, to those who want to see more technology development in this area, it's not the whole story, and it's worth keeping that in mind.
And no energy conversation would be complete without a mention of natural gas. And the question is, since the low cost of natural gas, has that contributed to the decline of clean energy investment? So, Phyllis, you want to answer, and then we'll let you. Did that clean up?
Well, I'm going to continue to be upbeat, and sure, natural gas is a competitor, but I also think natural gas and clean energy don't have to be antagonists. They can be colleagues, and so. If you look at what most forecasters are saying, they're saying, in two years ago, half of all installed capacity in the United States was clean energy. If you look at what forecasters are saying about Europe, it's more like, 70% of all new installed capacity is going to be clean energy. So there's been a lot of time and attention spent on natural gas, and I think what's interesting is that despite all that time and attention and enthusiasm about natural gas, clean energy still represents $250 billion in the annual economy and is going to grow according to, well, at least I'm upbeat about that. I think Ethan has said as much as well. So, I think that sure, natural gas has had a lot of time and attention, but we have to look at the facts that clean energy is continuing to become more competitive in the marketplace, and that only makes it more attractive to investors. So, anyway.
If I could just add one quick thing, which is also just I think that when in the U.S. we tend to have a very U.S.-centric perspective on gas, which is, gas is $4 or $5 per million BTU, and wow, that's super cheap. Well, actually, that's true, yes, in North America, but the cost of gas is 2 or 3 times as high in Asia and in Europe at the moment. And so the kind of collapse in gas prices that we've seen here, natural gas prices, is really not nearly as prevalent elsewhere around the world, at least not yet. Some say that that this fracking revolution can be exported, but we'll have to see. So my only point is that the competition, sort of price competition between gas and renewables has a very different look in other countries around the world than it does here in the U.S.
And Ian, wouldn't you agree that, again, if you look at a lot of markets, natural gas takes infrastructure, which is one of the benefits that clean energy has and why it is already competitive and attractive.
Well, clearly it does, and also, when you do a straight, price comparison between the two, I do think it's always important to recognize, and we do this frankly ourselves at Bloomberg New Energy Finance. We have a levelized cost of energy analysis, but when you try and look at the two technologies on a dollar per megawatt hour basis, you have to make certain assumptions, and there's really two very different ones that you have to make when you compare gas to renewables. In the case of renewables, once you build the project, you know what your operating costs effectively are going to be going forward, because you don't have to pay for your fuel, the wind or the sun. With gas, to do essentially a levelized cost analysis, you have to make certain assumptions about what the price of gas will be now and for the next 15 or 20 years. And the fact of the matter is that there's no question we're experiencing a low-price natural gas period, and frankly, we forecast the gas prices are going to stay low for a while, but we could be wrong. And historically, natural gas prices have been one of the most difficult things for anybody to predict, and so that unpredictability, that variability, is very hard to factor into things. And the one thing that renewables clearly do have on their side is that once you've built the project, you pretty much know what your costs are. You spent them, but you don't really have to worry about fuel fluctuation going forward.
I went home just last night to open the mail and had a letter asking me to lock in a price for natural gas over the next year. So, to your point.
Yeah, take it, I guess.
Okay, if there are just a couple of things before we conclude. One is that there's going to be a survey that pops up that essentially asks if we have all done a good job in presenting this report and if you enjoyed yourselves in terms of listening. So we hope that you would take that. It always helps us in in our future efforts. The other thing that I would say is I'd like to put in a plug. If you are not a member of our Clean Energy Business Network, there's no fee. We provide a lot of information and networking opportunities, and if you aren't a member, please join today. One of the advantages of being a member is that you have a quarterly research brief from Bloomberg New Energy Finance, in fact, and so it's packed with all kinds of useful information, and I think we're putting out our first brief in April, but you have to be a member to get that. So that's all I have. I really want to thank everyone for signing on today, and particularly to Ethan and BNEF for our collaboration on this report and other projects. And so thanks to you, Ethan, for being on, and everyone else on the phone. Thanks a lot.